Let's go to our first special guest, Matt Williams, who's head of Australian equities at Airlie Funds Management. Matt will speak to how his firm has managed to handily beat the market since it was formed in 2011, and his top stock ideas. Hi Matt, thanks for coming on the Wealth of Experience podcast.
Thanks, James. Thanks for having me. Long-time listener, first-time guest.
Great. Can you tell us first about your career in funds management to date?
Well, I was reflecting the other day. It's been 30 years since I went off to Perpetual with my packed lunch from Mum in my short pants. And, look, it's been a long, great story for me. I've been very lucky. I feel just totally privileged to be firstly in the industry and to work with some great people, great teams, too many to mention, but none better than our team at Airlie Funds Management where I am now. And look, it's funny to think that 30 years ago, my colleague, now Emma Fisher, who I work closely with, was at preschool when I was sent off to Perpetual. And other members of our team, Joe Wright, Vinay Ranjan, Will Granger, the senior members, they weren't even born, I think, at that point. But, I really love that. I think in this game, investment principles don't change much, but obviously the world does. And having youth and experience, a mix of that is really important. And so, look, I feel, as I said, really lucky, great industry. It remains intellectually challenging. There's all these great characters amongst, company management, other fund managers and clients. And I still, after 30 years, I still really love it.
It must be funny initially going into the door at Perpetual as a junior and learning off senior people and potentially idols, and then now you're one of the senior people and you've got these young whippersnappers learning off you. It's quite an about turn over that period of time.
Well, that's right, and I love telling them all my young, the young people at work, all my war stories, and they love it. Of course, hearing me drone on about what happened in 1998 with this management team and this company, and I get the opportunity to bore them senseless.
Very well. Now, Airlie itself has found some success since being founded in 2011. What's its edge, do you think?
Airlie was started by my good mate John Sevior, who I worked with at Perpetual, and I joined in 2016. And Emma Fisher joined a few months after that. And as I mentioned before, Emma and I have developed a great working partnership and we've put together a great team. We merged with Magellan in 2018 and now that's been good and bad, but that's probably for another podcast. But overall, Magellan have been very good to us and the merger has delivered from a business perspective everything that it promised. And look, I think, Magellan, just briefly, I think things are looking up there with Andrew Formica as the new executive chairman, some new experienced board members, so I'm quite encouraged about the future there. But look, it's a long haul out from where they, currently find themselves. In terms of edge, we have had good, consistent period of outperformance. Emma Fisher, running our retail fund, the listed Airlie Australian Share Fund, and she's really delivered on that. But as to an edge, it's a question. After all these years in the market, I really struggle to answer. I don't think we are any smarter or apply any technology that other managers don't. I think our edge, if I had to define it, is staying disciplined around our investment process. And now, look, I can probably hear the collective eye rolling of all your listeners as I sort of say that, but I think it's a true fact. Our process of buying, just quality companies with rock solid balance sheets, keep us out of the sort of short-term incremental winners. Think about the buy now, pay later frenzy where we didn't participate, but also keeps us out of the medium-term losers and think again of the buy now, pay later, bubble busting there. So we think that it's half the time it's not what you own in a portfolio, it's also what you avoid. And stocks with bad balance sheets, can really, really damage a portfolio as the balance sheet comes into play. And a great recent example of that, I guess, would be Star Group. And there's been plenty of others over the years, even Lend-Lease I'd put into that, just avoiding these kind of companies can really improve your returns.
I did roll my eyes a little bit there, Matt, I must confess, but I have seen presentations from Airlie where it is a pretty strict kind of process. You do have a discipline around balance sheets, insider kind of ownership as well, founder-led companies, other things that really need to get into your screen to really qualify as a quality stock. Can you run through a bit of that, exactly what that process entails?
Yeah, so it starts with that financial strength, and that is the key gate for any company to make it through, because what we want to take off the table is whatever happens in the macro, whatever sort of surprise is out there for any individual company or a big cyclical unexpected turn, we want to be able to say that the company's going to survive that and won't be overly damaged in a share price perspective. So that's the key thing. And then the rest of the process is all about trade-offs, right? I mean, it'd be easy to just find the best companies in Australia when we know what they are mostly and just pay any price for those. But we don't do that either. What we're looking for is undervalued quality. And so we're looking for quality businesses. And what that quality to us is about a uniqueness in the franchise, that allows a company to earn a sustainable higher rate of return, which then means excess cash flow, which means a stronger balance sheet, and then capital management options. And you get in this virtual circle of, excess returns feeding through to this. So think about, a company with a unique franchise like James Hardie with a unique building product that it has, Aristocrat with its unique content, Bunnings, part of the Wesfarmers Group. These are unique kind of businesses. And so we're looking for businesses like that, but they're priced. For some reason, the market's taken a set against them at any certain point in time. Maybe they're worried about the cycle, like what's happened to James Hardie. 12 months ago, James Hardie was under $30 because of worries over the cycle.
Yes. And now it's 46 or something.
And now it's
right?
46 and, up 10% yesterday after a quarterly result. And, we think probably heading higher because of the way the business is set up. So we're looking for those kind of opportunities when the market presents themselves to us.
So it's easy to buy quality, as you recognise that the quality stocks are out there, people know about them. How do you focus on when a stock gets hit? Say a James Hardie, say a ResMed, say a CSL, the blue chips that get hit, how do you distinguish between those that have got kind of permanent damage to not so permanent damage?
Yeah, that's where a lot of assessment and a lot of work gets done. We make we get our hands dirty trying to find industry contacts, doing the network type calls to really get a handle on what's going on. So, look, a great example, as you've pointed out, is ResMed, and again, this business fits our unique franchise model, and the profits have compounded in ResMed over the last 10 years at about 15% per annum. It's remarkable. However, at $34, where it was only 6 months ago or so, we did not own it because of that valuation piece. We couldn't justify the valuation piece. So what's happened now is pretty simple. Obviously, the stock is off 30% on worries about the GLP-1 weight loss drugs, and we've done a lot of work around that. And to our best estimates, it's at 30% down. The stock has been unduly punished, and hence provides an opportunity for us to make money, we hope, over the next couple of years. So that's the kind of thing we're looking for.
I'll give you two pushbacks on it, just to put it out there. One would be that GLP, it's quite uncertain about exactly what impact it will have. So is it a risk-reward thing with you guys, in that you're saying that that it could have some damage, but it won't be as much as is being factored into the share price?
That's exactly it. It's as simple as that. Look, I think the payoff where with the stock where it is pretty good, and it'll probably take 2 years or so for us to know if we are right. Because if we're wrong, well, the market has already factored in a pretty dire outcome. So that risk reward, that payoff, that probability is looking, we think, in our favour, given the work we've done and what we think the actual effect of GLP-1s will be. Now, look, we could be wrong. We get a lot wrong, but we've got to get more right than wrong. But we'll see on that. But the probability, I think, is lower. Is lower that things will, the stock will drop another 30% to as against a fairly hefty upside if we're right.
The other one I've heard is that even though it's come back, it's still not cheap on basic screens like a PE screen or whatever. Are you counting on basically compounding earnings to really sort of to lower that multiple over time and for it to attain perhaps a steady or higher multiple going forwards as well on those earnings? Yeah,
short answer, yes. And also you say, it's not that cheap, but it's actually under the industrial market average on a forward PE. And, as I've said, this is a unique franchise, and that's never been the case for as long as I've sort of looked at ResMed. So we think the valuation, again, sort of factors in a pretty dire outcome.
Let's move on to some other stocks. I know that you guys were buying into retail quite heavily mid this year. Do you still find them attractive after they've ticked up a bit since then?
Yeah, look, some. Those with, again, going back to our process and that first step, those with rock-solid balance sheets. Retail is a highly leveraged, operationally leveraged business. And so you want to make sure you're in those absolutely bulletproof kind of balance sheets. And so, again, we're talking Bunnings, part of Wesfarmers, Premier Investments with its Smiggle and Peter Alexander brands, and Nick Scali. And so, look, we trade around these core positions. We buy heavily when the market hates them for, cycle reasons, et cetera. And then we sell them when the market, things are a bit more favourable. But we've owned these stocks in the portfolio for, since early inception almost. The stock I'd really like to have a share price hiccup would be JB Hi-Fi. I think, again, a really unique business and with high quality management. So, I'd love to see that stock a lot lower and get a chance to buy into that one.
And in terms of other sectors that you own, you don't own a lot of commodity stocks in general, but one that you do own is Mineral Resources. Can you tell us why that is?
Yeah, look, I think first up, commodity stocks, it's hard to find that unique angle in obviously by name, commodity. And we don't feel we have the expertise a lot of times to judge sort of single mine characteristics. The geology is always a bit different. There's some expertise in really judging, a lot of mines. I'm not including this in the bulk, iron ore and coal produce. That's pretty simple, and hence we own those. So, digging up iron ore is not that complicated. But Mineral Resources, to answer the question, we've known since 2006. And the unique thing about this business is the mining services segment that has been exposed to production, not CapEx. So it doesn't go through those wild cyclical swings that you see in other mining services business. It's just been a really steady increase in earnings. And that has allowed the company then to take that cash flow and do really other, great things with it. And this is where the uniqueness comes in, because the unique thing about Mineral Resources is the founder, Chris Ellison, whose record on capital allocation is just phenomenal. They've developed a lot of optionality around iron ore, lithium, gas, and it's all been backed by the steady earnings from their mining services business.
You're okay with the move into lithium and how that'll ramp up?
Yeah, well, he was early to it, and did one of the deals of the decade in that they bought Wodgina for an undisclosed amount because it was undisclosed because it was immaterial. So, under $50 million, let's say, and they've sold, half that business to Albemarle for well over, US $1 billion. So one of the all-time great deals. So, yeah, look, we think lithium has been a very volatile sort of space in the last 12 months. As the industry sort of tries to come to grips with what's the cost curve, what's the, where do the costs actually sit in the business, and a and still a fledgling demand environment in terms of EVs as all the car makers tool up to do EVs. And so, look, it's volatile, but we're backing the company in their long-term view that lithium is a great space. And I think the fact that they've got iron ore and, again, that mining services business sort of just makes it a more palatable player than a pure player.
And where else are you finding value in the market?
Just recently, packaging and glass manufacturing business, or Aurora, we think is interesting. They've actually committed the triple sin of, firstly, buying a massive business, really betting the farm on an acquisition. Secondly, they've bought this business in a new jurisdiction. Mostly it's in Europe. They're not in Europe. And thirdly, the ultimate sin in my book is they've bought it off private equity. So almost a triple strike. Because look, we've seen this movie before, right? Aussie company goes offshore and blows themselves sky high, going well back in National Australia Bank, QBE, IAG in London Insurance, Boral in more recent times with Headwater, Slater and Gordon, Bunnings had a go as well. The list goes on and on. So they've done that. However, the market knows this as well, and they've taken the share price down to a level that has really encapsulated, really hit this company for what's happened. We're well below now the equity raise price, so we just think it's too cheap. We've done a lot more work since the acquisition announced about the business they've bought. It's called Saverglass, a French sort of specialty glass manufacturing business. We've done a lot more work on that, so we're feeling a little bit more comfortable about it. And in fact, we've added to the position. It looks very cheap if the numbers stack up. So that's one. A company we've got wrong in the last 12 months has been Tabcorp. Possibly because when looking at our quality sort of tests, maybe the franchise is not unique enough. It's the second biggest player, but second by a bit of a distance in mostly a 3-player market. And I guess what we do like about it is the industry structure is improving. The company has a great balance sheet. Again, of course, that's the first line. Has to have a great balance sheet. So with improving industry structure, a bit of self-help coming out of a demerger with the Lottery Corp. Generally, demergers have been great places to be. But this one, as I said, we've gotten wrong in the last 12 months, but we're hopeful.
Yeah, I used to be a Tabcorp analyst a while ago. It was sort of the online wagering threat that was always there. Is that sort of playing out, and could that impact them sort of going forwards, or they kind of riding that and getting better at it? Yeah,
a bit of both there. They've been thoroughly spanked by the biggest player to come into in the online wagering space is Sportsbet, owned by Flutter, the giant Flutter Corp, which has operations around the world. It's the dominant player, and Tabcorp has just struggled to catch up. To catch up. And look, to be fair to the company, they've had one hand tied behind their back with sort of historic regulatory issues that they've very slowly but surely unbundling themselves from. And this is the part where I'm saying the industry structure is improving for them.
And just more broadly, you run concentrated portfolios. Why is that? Why are they so concentrated in your view?
I think as my career has developed over the 30 years, you get to learn that 25 to 30 stocks can provide enough diversification. And I think as the rise of passive, alternatives for investors, active managers need to be active. We really need to show that we know what we're doing, and all this research that we're doing means something and can pay off. And so you've just got to narrow your focus into those best ideas I think the days of when I started 30 years ago, portfolios might have had 70, 80 names in them, back then in the 90s. I just don't think that makes any sense, particularly in a market in Australia where there's just not the depth and breadth available. So concentrate is the way to go. Best ideas, and really own a lot of those best ideas, and they've got to be right.
Yeah, and your funds are very different from the benchmarks and indices, right?
Well, that's the hope. I mean, again, if you're charging active fees, you've got to be active against that benchmark. And as I said, that what's the historic and relationship? All the studies show that if you're batting a 55% average or so when you're right, then should outperform. So you're going to be wrong a lot of the time, even though you are trying to focus on those best ideas. But if you get that batting average over 50, that's where the good outperformance, relative outperformance, can come from.
I appreciate you taking the time to come in today, Matt, and thanks very much.
James, it's been a pleasure. Thank you.
That was Airlie Funds Management's Matt Williams.